Welcome to this update, and thanks for taking the time to receive an update on where things are at with regard to Palisade's Unlisted Infrastructure Trust.
Just started.
For those of you who don't know me, I'm Matt Dell. I'm from Pinnacle. I'm in the distribution team. It's been a few months since we asked for applications to be completed for PUIT. So we thought it would be timely to provide an update on where we're at with regard to capital calls, but also to provide an update on the existing fund that PUIT will feed into. That's Palisade's Diversified Infrastructure Fund, so PDIF. So we talk about PUIT and PDIF. You'll hear Killer refer to those two funds as we go through the presentation today. Our speakers today are Palisade's Managing Director and CEO, Roger Lloyd, and Investment Director, Andrew Killesteyn. Before we start, the plan is just to run through the presentation for about 25 minutes, and then we'll open up the meeting for questions. Now, because of the relatively small number of people on the call, we will take live questions. So remember to, if you would like to ask a question, just to unmute yourself before you ask a question. Otherwise, please remain muted so we avoid background noise. At the end of today's session, we will send the presentation through to everyone who attended. So with that, let's begin, and I'll hand over to Andrew Killesteyn.
Great, thanks, Matt, and hopefully everyone can see me and hear me. But look, welcome everyone, and absolute pleasure to be presenting this afternoon. As Matt said, we launched the fund earlier in the year, and obviously a lot has happened in the market, and in particular the infrastructure space in that time, and very happy to be providing you an update on the fund. So firstly, I'll just give you an update on the fund, and when I refer to the fund, I am of course talking about Palisade's Unlisted Infrastructure Trust, which is our wholesale fund that we brought to market, which you've committed to. As Matt said, that fund effectively acts as a feeder fund into our flagship institutional vehicle, which is Palisade's Diversified Infrastructure Fund, or PDIF. So with that, we'll also provide an update on PDIF's performance and how it's fared over the last 6 or so months as we navigate the new world. We'd then like to just step through a couple of the key sectors that PDIF is invested in, infrastructure sectors, and just provide you some oversight on sort of what's happening in each of the sectors that we're invested in. I think the airport sector at the moment is fairly topical with the relevant sort of border closures and the like. So very happy to provide you an update on that, and also take questions. And then just rounding out, we'll touch on some of the themes from an origination perspective, and sort of some of the projects and investments that we're working on at the moment, which is obviously relevant to the timing of drawing capital into the fund. Just moving across. So in terms of the fund, you recall that we went out to market with a $100 million target to raise. We're currently at $97 million, so we're in the final stages of rounding out that capital raise. You'll recall that the way in which the diversified fund, so PDIF, takes commitments is via a commitment queue, and so we went through the process of preemptively putting in place an investment from PUIT into PDIF in March 2019 of $100 million before we had raised the capital, but obviously we had a degree of confidence that the capital would be able to be raised. And it wasn't until earlier this year, as I said, that we actually launched the fundraise with that target of 100 million. So we're very pleased to be able to get to the 100 million or close to the 100 million, and I'm sure that we'll round out that last $3 million over the next several weeks. But pleasingly, we've had support from over 300 individual wholesale investors, which is really very pleasing for us as a business. Largely our business has been institutionally focused, and we've always had a desire to provide access to the wholesale market to what we do. And so we're very pleased that we've been able to get that coverage across the fund. In terms of drawdown, so the way in which we draw down capital into the Diversified Fund from PUIT will be when the Diversified Fund requires capital to either fund various initiatives that we're undertaking within the portfolio companies in the fund, or to fund new investments. We are currently working on a number of new investments, but also pleasingly as well, there's a number of projects that we're working on where we're deploying capital through the existing portfolio companies. So based on what we have on the books today and the projects that we have under due diligence, we're currently expecting to commence drawing down capital, I think realistically the first half of next year. And then that will continue on. The remainder of that capital will continue on. We're targeting in the back end of next year. We've obviously explained in the past, inherently this is an asset class which can often be quite opportunistic, can be quite lumpy in terms of when transactions become available. So we ask that you be patient, and we're aware that you have been. But equally as well, we are seeing a fairly robust pipeline of opportunities. So, we are targeting to commence that drawing of capital next year. I might just hand over to Roger now to provide an update on how our Diversified Fund has performed over the last little while. And also just to provide an overview of the portfolio as well, Rog.
Wonderful, thank you. And contrary to the label on my video there, I'm not Matt Dell. Matt Dell's the chap above me. Roger Lloyd is my name. I've met many of you, and good to see you in this forum. If we can just go to slide 6, I believe it is. Yep, that's the one. It's a fairly busy slide, but it does contain a lot of relevant information in relation to the fund. And I'll talk first of all about the charts at the bottom, because this gives a very good idea as to what the composition of the portfolio, and why we've managed to really ensure we're not caught up in COVID in a major way. So we've got a very diverse portfolio. As you can see bottom left, that pie chart shows the diversity across the portfolio. Currently got 24 assets that we manage within PDIF, and it's across all sectors, from airports, ports, bulk liquid terminals. We've got a couple of gas pipelines in there as well. We've got a fairly significant renewables portfolio as well that we manage. Through social infrastructure and data, as well as some sort of ancillary infrastructure things. We've got agri-infrastructure through our regional livestock exchanges, and we have a car park asset, but attached to infrastructure, attached to hospitals. So that has been our objective, is to make sure that we've got a diversified portfolio, and that's definitely something we've managed to achieve to date. The revenue composition is important, and it is what has largely protected us during this COVID period. The majority of our revenues, and by majority I'm talking 60-odd% of the portfolio, are actually contracted revenues, and with solid creditworthy counterparties. It's meant that our revenues have been protected through this period. Where we have obviously not been protected is where we have volume driven or GDP linked, in this case transport of goods and people, particularly in the shape of the airports. We've got 3 airports in the portfolio: Darwin, Alice Springs, and Sunshine Coast Airport currently. And obviously those have been extraordinarily hard hit, but it is limited to only a third of the portfolio. which has meant that our returns have held up over the last through this period, but over the last 12 months, you can see we're still returning 5.1% total return. We have had a small drawdown, 2.2% decline in capital growth, and that relates to the airport assets in the main, but still generating very good incomes, which you can see bottom right. You can see our historical, the dark bars there, the historical income returns or net yield returns, and then the lighter ones going forward. Obviously, we've got a hit during FY21, mainly related to the airport assets, where they're effectively in lock-up with the banks until such time as we're clear of this coronavirus and the borders open and we resume, which we are expecting to happen during FY22. Regardless, we are generating revenue from the other assets during this period of time. I think there's something I'd really like to point out, though, is the sort of stability of these returns over time. And I've got 3 charts following this that really demonstrate this. If you look at our 10 years, our 10-year numbers, close to 11% return, and 6% of that has been income yield. We're obviously very, very proud of those numbers, and you can see we've generated those over the long term. The next 3 charts are interesting, and some of you may have seen these before, but just really demonstrate the stability of our returns. Firstly is performance relative to other sectors, and as you can see, other asset classes, that is, and as you can see, the Diversified Fund has ranked top quartile in 5 of the last 9 years, and we expect that, and we can actually go to the next slide now. We expect that because one of our objectives from investing into infrastructure is protection of capital. Number 1 is key, and secondly, to generate long-term sustainable cash flow. This chart just shows you with the PDIF maximum drawdown, and that's in this most recent period of close to 2% or just over 2%, and that related to a devaluation of our airport assets at April and June. So that's drawdown, but that really is that it's negligible drawdown, and capital protection is that key. The next slide then talks about the stability of returns. And you can see there that the light blue line is the Diversified Fund has continued to generate strong returns over that 10-year period, and happy to say looks to be in second place now, given the sharp decline of the other asset classes. I might pause there and let you take it from here.
Great, thanks, Rog. So we just wanted to provide a bit of an update and some commentary on what we're seeing across some of the key sectors that we're investing in. I think airports, yes, they are a significant part of our portfolio, around sort of 25 to 30% of the portfolio. I think airports are incredibly resilient assets, and they certainly have a place within any sort of well-performing infrastructure portfolio. I think, yes, we've seen some challenges in the airport sector of late, but they are really that part of the portfolio that does provide that sort of modest capital growth that we are seeking, that complements that capital protection that we get from our more contracted assets. So we currently have 2 airports in the group in our portfolio, being Airport Development Group, which is Darwin and Alice Springs as a group, and then we also have Sunshine Coast Airport. Look, both airports have been significantly hit, as you would expect. To give you a sense of where both are trading at the moment, currently Airport Development Group is operating at around 35 to 40% of pre-COVID volumes. Sunny Coast a little bit harder hit because Sunny Coast's prime routes are Sydney and Melbourne, and obviously with the Queensland border closures, we've seen a more significant impact on those airport numbers. We are forecasting that with the expected border closure to be lifted by Queensland in the coming coming weeks to month. Where we're expecting Sunny Coast to particularly those Sydney and Melbourne routes to recover somewhat by the end of the year, and then further into the ensuing years. For Sunny Coast, we've also been very successful, and this was always part of the business plan in terms of building out the domestic route development network. We've managed to do that. We've put on an additional Qantas service from Sydney, but equally as well, over the last month or so, we've announced 2 new services with Alliance Airlines, being a Cairns service and a Canberra service. Obviously, both of those routes are not impacted by the current border closures. There's been a big focus on cost control at both airports, particularly with Sunshine Coast Airport. We've managed to temporarily reduce the cost base by about 50%. That's been done by a variety of measures, including reductions to executive pay. We've also gone through a process of reviewing the capital expenditure plans and look to defer all non-essential capex. We've got debt waivers in place for both airports at no additional cost, and those debt waivers go through to June 2021. Part of that condition, obviously, is that all distributions will be retained and all cash will be retained within the company. And so certainly from a liquidity perspective, we want to ensure that those airports are in the best position possible to come out of the current environment. That's what's driving that suppressed yield in FY21 for the portfolio. From a valuation perspective, all of our assets are independently valued, typically by the big 4 accounting firms, and so that they've been independently valued as a result of the current environment, and new traffic projections have been included in those valuations. We've typically seen around between a 5 and a 10% drop across our airport positions in valuation from pre-COVID levels. I think there's a couple of points to note. One is that both airport groups have relatively low levels of international passenger mix compared to some of the more capital city airports. That has provided a more muted or somewhat of a protection against the current environment. From a valuation perspective, given that there's an acknowledgement that the domestic recovery will be significantly quicker or nearer than the international recovery. The other factor is that Sunny Coast is expected to benefit from domestic tourism, but obviously that's contingent on the borders being lifted. Across the board, though, we do remain committed to our regional airport strategy. We're currently in the process and in final negotiations to look at and invest in another regional airport, and there's several others that we're looking at. On the ports and terminals sector, so by
Andrew, can I interrupt at all and just ask a question just on airports?
Sure.
Just there was some press a few months ago regarding Sunshine Coast, and I think it had to do with the new runway that got put in. I don't think it was, if I recall, the reporting was unfavourable, but it felt like it was reported poorly. Was that the case?
Absolutely.
I'll comment on that if I could, Craig.
Sure.
Yeah, look, it was pretty poor reporting, to tell the truth, by the lady at the Australian. Don't quite understand what the point of the article was. The way that we structured the acquisition of that asset is we acquired the existing airport whilst the new runway was then to be constructed, and what that meant is we had a relatively small upfront payment for the airport, and then we had this big deferred commitment in June 2022. Not quite sure why there was sort of a question over that payment, or whether it could be made or not, because it's a commitment we've got, and we've got funding available, and we're obviously, we're pretty bullish on Sunshine Coast. I think of all the airports in Australia, that's one that is going to recover relatively quickly. So I was a little uncertain as to the purpose of that report, but yeah, we read it.
Thanks for that.
While we're on it, guys, in terms of the valuation versus the fall off the cliff in passenger numbers, do you think that's about as severe as it'll get in terms of the valuations, the 6 or 7%?
Yeah, I'll comment on this, and Andrew, pick up anything I miss out. Yeah, I think that is it. We took a pretty hard look at it, and we still do, month by month, at recovery. You've got to remember these are 99-year leases. So, sure, we will have 12 months of difficult times, and then we've got a relatively slow forecast ramp back to pre-COVID levels. But those are all in the forecast now. So unless, and obviously we don't know, Chris, but unless we have, a third wave, or, the borders don't reopen, we're fairly confident that our forecasts are now as correct as they can be with the information we've got today.
Okay, and just one other thing, from the front of the presentation, you had a net 5.2 or something, whereas I think the June 30 slides had a net 7. Has there been some assets that have been valued down between June 30 and now?
That was probably on the income side. Chris, the June numbers would have taken into account perhaps some income that fell out of the 12-month return, and then on the capital side, the main change in the portfolio valuation was Sunshine Coast was revalued again at September.
Okay, right.
And the key difference between the June valuation and the September valuation was really the impact of the second wave. So the June valuation, those traffic forecasts were done in late May. And so it was at that time when I don't think the second wave had really been experienced in Australia. And so the forecast that the independent valuers adopted for the June valuation for Sunshine Coast Airport assumed that those Sydney and Melbourne routes would start to fly again in September.
Yeah.
Whereas obviously that hasn't happened. So the new valuation was done at the end of September, factors in that wave. And effectively the profile of the traffic is that, it slowly steps up towards the end of this year, and then there's a recovery out until FY23.
Okay, thanks.
So just moving on to the sort of ports and terminal sector. So we have one port within our portfolio, being Port of Portland, which is a bulk commodity port down in southwest Victoria. I think just the port sector in general, was heavily impacted, sort of equally with the airports. We saw a significant decline in volumes across all Australian ports. And, a lot of that was driven by delays of Chinese imports and also cancellation of orders of the exports of Australian goods. I think unlike the airports, though, most ports across the country have exhibited a level of recovery, and obviously the extent of that recovery is sort of dependent on the trade mix of each individual port. But certainly from a Port of Portland perspective, the main trades going through that port are forestry products, so logs and wood chips. And then there's also some grain, mineral sands, fertiliser, livestock, and also some aluminium volumes that are attached to the smelter in Portland. We've seen a very strong rebound in Portland volumes, so much so that we're running about 30% ahead of budget for FY21. The area that we're still seeing a little bit of softness is in the hardwood chips sector, which is mainly exported to Asia for production of paper. The one thing I would say, though, is that particularly with those hardwood chip volumes, a significant proportion of those volumes are underpinned by minimum volume take or pay contracts out until 2040. So that serves as a sort of key sort of mitigant to those volume declines, and it's something that we saw during the early part of this year when Portland's volumes were down 37% in February and March, but the actual earnings of the port were down about 8 or 9%. And the reason for that discrepancy between volume and earnings was those protection from the take or pay contracts. So, we're quietly confident that Portland is in a fairly good position now, and we're already starting to see some recovery in those hardwood chip volumes as well. On the bulk liquids terminal side, so for those that don't know, bulk liquid terminals are those big white tanks that you see port side that store a variety of products. This is a business that is characterised by sort of take or pay contracts with various off-takers to effectively store product. So only a very small portion of the business is based on throughput. It's typically based on, as I said, sort of take or pay contracts. From a COVID perspective, we didn't see a lot of impact to this business given that contracting structure. Certainly from a COVID perspective, it's been sort of very well protected. I think the other sort of significant factor in this business is that at the end of last year, we almost doubled the size of this business by transacting on GrainCorp's bulk liquids terminals business. So GrainCorp, obviously big grain company in Australia, went through the process of looking at sort of divestment of various non-core businesses. Their bulk liquids terminals business was one of those businesses, and so we're in a position where we could acquire that through our existing terminals business on a negotiated basis, which we closed at the end of last year. Why we liked that transaction was it provided exposure to a new set of products which we hadn't, which we didn't have exposure to in our existing business. So mainly in the fats and edible oils product suite, which obviously sort of complements the existing business, which is more geared towards sort of various petrochemicals and fuels. Along with that transaction, we also signed a long-term agreement with GrainCorp to store their products. So it was similar to a sort of sale and leaseback transaction for part of the volumes there. We do see continuing investment opportunities in this area. The government has been very strong on looking at increasing their strategic fuel reserves to bring them more into line with international standards. International standards are currently at 90 days, and I'm not sure what the latest number is, but several months ago, Australia's fuel reserves were around sort of 28 or 30 days. So there is an impetus from the government to look at sort of increasing those strategic fuel reserves, and also to support domestic manufacturing, which a lot of the products within our bulk liquids terminals sort of is used as feedstock for. Just very quickly, from a sort of energy and gas perspective, we still believe that gas has a role to play in the Australian market, despite the rise of renewables. I think the reality is that gas will very much play the role as a transitional fuel in the Australian market, particularly as there's further coal retirements over the next decade or so. The reality is that given the intermittent nature of renewable energy, there needs to be some sort of firming of energy provided, because the wind doesn't blow all the time and the sun doesn't shine. So at the moment, that role is being played by gas, and it is far and away the cheapest mechanism, or the cheapest firming technology there is for those intermittent periods of power. We own two gas pipelines in our portfolio: the North Queensland Gas Pipeline, which takes gas from the Moranbah Gas Basin up to Townsville, and the Tasmanian Gas Pipeline, which takes gas south from Longford in Victoria down to Tasmania. Both of those are the exclusive sources of gas for those two regions, and very strategic in the sense that they supply gas to gas power stations in those regions. So from an energy security of supply perspective, they're critical to those regions. Both assets are underpinned by take or pay contracts. So again, regardless of the amount of gas that flows through those pipes, we're paid a revenue stream for that. So you can appreciate that during the COVID environment, both those assets were very were not affected at all. From a renewables perspective, this is something that Palisade as a house has always been very strong on renewables and keen to participate in the renewables build-out that's happening in Australia. We have a portfolio of 5 renewables assets. Having long-term power purchase agreements is absolutely critical to to our strategy. And currently, over 95% of the portfolio is contracted with tier 1 off-takers. We've currently got all 3 major retailers in the portfolio, as well as Hydro Tasmania, which is owned by the Tasmanian government. We're very much focused on building out our renewables portfolio. There's a number of transactions that we're looking at the moment across both the brownfield and the greenfield space, and we're also pursuing and looking at a number of projects which assist in that transmittancy issue, which I discussed before, around those firming technologies. And the 2 key firming technologies are, green hydrogen, which is effectively producing hydrogen from excess renewable energy. So effectively when the wind is blowing and there's no demand for that power, that power is then used to power an electrolyzer to create hydrogen. So that acts as a store of renewable energy. And the other sort of area of those firming technologies is pumped hydro, which is effectively utilising excess renewable energy to pump water up a hill, and then that water is released to spin turbines. So those sort of 2 areas, I think, are going to be a key sort of focus of those firming technologies in the renewable space. Just rounding out very quickly on social infrastructure, PPPs and communications. So we currently have a portfolio of 7 PPP assets in our portfolio. Now these assets have their revenue streams are effectively government availability revenue streams. So effectively, if you make the facility available and meet certain KPIs, then you are paid your quarterly payment from the government. Even where there's an abatement issued against the project for failing to meet KPIs, generally those liabilities or obligations are passed through to the actual operators of these projects. So very low risk investments. They currently make up around 6 or 7% of the PDIF portfolio, and you can appreciate that this was one of the sort of key sectors that we looked at when sort of providing that protection for the portfolio. We are seeing a number of follow-on projects which we're executing through the portfolio. We're currently in final stages of negotiating the stage 3 of the Gold Coast Light Rail. We've delivered stages 1 and 2, and then we also see a big need for further PPP investment as the government looks to look to the private sector to deliver on the huge amount of public infrastructure that the government is looking at delivering as part of the COVID recovery. Finally, just on communications. So this is an area of infrastructure which we've been keen on for a couple of years now. It's a hugely fast-growing sector, as you can appreciate. We've currently got an existing submarine cable investment that takes data from the US to Australia. Very keen on sort of exploring whether there's further opportunities to do in this part of the market. But I think particularly with the onset of COVID, it was already a fast-growing sector, but particularly with the onset of COVID, that has magnified the amount of data that people are using. And so I'm very keen to explore sort of other transactions in this area. Rog, I might just hand over to you just to round out on some of the sort of key high-level themes that COVID has thrown up, particularly as it relates to sort of our strategy with respect to sort of opportunities going forward.
You're muted, Roger.
The most used term in the last 6 months.
Yes.
Thanks Thanks, Killer. Just to cover very quickly to wrap this up, where we're seeing potential activity in the sector, effectively through four ways. Everybody's reading about, hearing about the infrastructure-led recovery. There's a need, and I think the stimulus programs that the state and also the federal government will put forward will mean there's going to be a huge amount of infrastructure required in this country, and hopefully they will bring the private sector into delivery of that. We're also seeing, I think, particularly since the last summer, the last horrible summer we just had, there's a lot greater emphasis on sustainable investment and sustainability related projects. I think that's going to drive a lot of investment into renewables. So we continue to invest in that, as Andrew talked about. And I think also because of the government stance on infrastructure and acceleration of delivery of infrastructure, what we are going to be able to see is more unsolicited bids into governments to develop assets for the economy in general, but generally government-funded projects. So we actually think that the government-led and the recovery-led projects will be good opportunities for us. A few other things that we're seeing: non-core asset sales. Andrew talked about an asset we bought last year from GrainCorp. Typical example of non-core asset sales. People will be looking to strengthen their balance sheets, getting rid of assets that aren't necessarily sitting in the right place. And you know, we hope to see a few more transactions like that as well. We haven't yet seen distress in infrastructure, and I don't necessarily expect to in the near term. But I think over time we may see, you know, over the next 6-12 months plus, we may see some distress as banks lose patience, perhaps with less high quality assets. But as I say, we haven't yet seen that, but we'll be looking at that very closely. And lastly, we've already seen it. We saw it quite an aggressive act by a superannuation fund taking on Opticom. That was First State or Aware Super, where they've basically taken a listed company and taken it private. There are going to be opportunities like that, I believe, although relatively limited in the Australian New Zealand economy. You know, we just don't have a lot of listed infrastructure assets. So that's sort of the four key themes. I think overall, though, it's around origination, it's around our acquisition. It has been a difficult time, obviously, to invest. You know, we are investing in real assets, yet we can't get around the country to see them. It's a difficult time to buy. That said, the team has remained incredibly engaged, and we are still seeing a lot of opportunity, just taking a little bit longer to actually execute on those opportunities. But that said, we're still relatively bullish in relation to our ability to get invested over the near term. Quite happy, Matt, to take questions.
Yeah. So, guys, sorry, it took a little bit longer than we'd hoped, but if you could just unmute yourself if you'd like to ask a question, and I'll just open it up to the floor right now. Okay. Okay. No questions? Is everyone comfortable with timing of capital calls?
Yep. Sorry, Matt. I just questioned capital calls. So sorry, the indication now is it's during first half of calendar year 2021. And if I've got a client he's also inquired directly with investing with Palisade, they'll be under the same capital call structure to anyone that's going via an advisor group.
Killer, you just unmute yourself.
Sorry, Craig, can you repeat that question? So you've got a client that is looking to
go... so I've got a client who's investing via Coda.
Yep.
And also a client, and the same client, I believe, is spoken to Palisade about investing directly because he wants to increase his allocation.
Yep.
He'll be under the same call structure under the PUIT.
Yeah, that's right. That's right.
Okay. Thank you.
Okay, do we have any other questions before we sign off? Okay, well, look, thanks everyone for taking time this afternoon to hear this update. Sorry, Chris, did you have another question there?
Yeah, I was just going to ask, just on the deployment, why it does keep getting pushed out. I think Roger mentioned a few things, like obviously not traveling to see assets, but we'd sort of been guided all along by Pinnacle that sort of there'd be a first call at the last quarter this year at the latest. Is there any reason why it's been pushed out another sort of 6 months? Obviously, we've just got to go back to clients and explain it. So the more detail we can get around the reasons, the easier it is to explain to them. Yeah,
sure. Chris, if you sort of think about the opportunities that we've talked about in the past that we're looking at, one of them in particular that we had expected to close early in the year was a regional airport. Obviously, that has been impacted as have all airports, and a very difficult time to complete a transaction of that sort. So I mean, it's simply, there's that's a prime example where the goalposts changed on us completely during the acquisition process when COVID stopped travel by an airport. And the other is, just opportunities where we weren't necessarily willing to pay prices that others have been. We're not we're investing for the long term. We're not paying. We're not just going to be sucked into the vortex, I think, which is evident at the moment in some sectors, and I won't necessarily name what they are, where very high prices are being paid for assets which we just weren't willing to do ourselves. And then the third is just access to assets. You just literally cannot do your due diligence on assets in this environment. Yeah, but also we expect that to open up shortly.
So if prices actually gone up, if anything, have they in the last 12 months?
We have seen that in some sectors for sure. When I say prices, the sector I'll talk about is renewables. And what we've actually seen is some acquirers desperate to get into the sector, probably because of that focus I talked about earlier. And what that's meant is that they've been willing to accept vendor forecasts around pricing, around prices of power, which we're not willing to. And we're heavily into the sector. We know the sector, better than most. We've got 750 megawatts that we manage, and so I think we know what we're willing to accept. Others were willing to accept a lot more bullish forecasts on power prices than we are. And for that reason, we're not competitive, and we don't want to be competitive in that environment. That's an example. So I prefer to take the pressure from you guys if I haven't got invested, rather than invest badly, if I can put it that way.
Yeah, fair point. All right, thanks for that.
Okay, last chance for questions before we wrap it up there, everyone. Okay, well, look, thanks again for taking the time to ask this afternoon to hear this update. If you do need any more information, please don't hesitate to contact your Pinnacle contact. You will know who that person is. We will send a copy of this presentation to everyone later this afternoon, so you've got that on file. And other than that, thanks again, and I hope you have a good evening.
Thank you all. Goodbye.
Bye.